Bank reconciliation proves the difference between cash per books and cash per bank. You'll see our bank reconciliation formula here. Balance per books equals bank balance minus outstanding checks plus outstanding checks. Another way to look at this is balance per bank equals balance per books plus outstanding checks minus outstanding deposits. The reconciliation shows the differences between the bank statement and the accounting record. I am not a huge fan of bank reconciliations, as sometimes they can be difficult, or sometimes it can be very easy. What the heck is the point of this? When we look at a balance sheet, we have our first account, cash. In a large company, this cash account might be the sum of 100, if not thousands of accounts. But in this case, let's just say cash is $10,000. And this balance sheet is at the year end, at a snapshot point in time, 12/31, calendar year end, $10,000. Now we go to our bank, and the bank statement says $11,500. There is a discrepancy here. Something's happening. How can a cash balance be different than a bank balance? The number one reason can be why? Because of checks. In the old-fashioned day, people wrote out a lot of checks. A lot of business is still done by checks, meaning that the check has been sent but has not cleared the bank. So this cash balance is similar to what is in one of those old check registry things. So you still reflect a lower balance. Also, when you look at your business cash or your business balance sheet, you want to see how much cash do you actually have to work off of. And then the bank will say here. So a very simple reconciliation would be going from, hey, the bank says this, and then cash says this. What the heck is the difference? Now, there's another thing called deposits in transit. Deposits in transit. Think of this as a stack of checks going to the bank. Nice problem to have. If it's Friday and people are like, oh, hey, we just don't have time to go to the bank, but we have some checks. That is also part of cash, because those checks, if they're good, are as good as cash. So these are checks outstanding. So here's a potential example. Let's say we have outstanding checks minus 2,000, and we're going to have a deposit in transit, these stack of checks, or for whatever reason not clearing, for 500. DIT, deposits in transit, coming into your cash per books. Now we have performed a reconciliation. Oftentimes ignored, it is so important. Accounting software is more and more automated, which makes processes like manual entry and bank reconciliations more interesting as far as, hey, did the software actually do this correctly? But what it also provides is an opportunity for error. So automatically transactions might be dumping in from financial institutions, bank balances might be wrong, credit card balances might be wrong. So while we are talking about a bank rec, you also might have credit card rec. You might want to reconcile the loan somehow, and even inventory, which will all take slightly different forms. But in this case, standard bank rec, going from cash per the books So this is cash books, and this is cash bank from the bank statement. Sometimes deposits also will need to be tied into various invoices. So you might have a deposit on January 8th, 2101, and the deposit equals $1,000. But you'll also have to figure out, hey, this was a $100 check, and an $800 check, a $50 check, and another $50 check. So in performing the bank rec, you will also look to see that the proper transactions have been allocated, because this might say 1,000, and that might not match to all of the invoicing that you did in your accounting software. Bank reconciliation also is such a crucial function that it involves the concept of segregation of duties, which is just a nice concept to introduce. Segregation of duties. On one side of the balance sheet you have AR, which is invoices being sent out. You also have cash. You also have accounts payable on the other side, right? You have people who sign checks. You have people who do reconciliations. You have people who send bills. We'll say send payment. And this is send bills for AR, send bills out. AP is processing. So if the same person does all of this, they can steal, they can hide, it's very easy. So in a perfect world, you would try and segregate a lot, if not all of these duties between approval, check signing, processing of invoices, and the bank reconciliation process. Not to be underestimated, simple on paper, but can be quite complicated for large transaction volumes, and the more things get automated, they also need to be checked to see if they tie into the actual bank accounts. This has been Bank Reconciliations with AccountingPlay.com. Thank you.